Hi, I'm Chris, managing partner of Edison Partners and the host of Electrifying Growth. This podcast is all about helping founders and leaders navigate the challenges of scaling their businesses. We get into the strategies, insights, and real-world experiences that fuel growth, because what got you here won't get you there. In this episode, I'm sharing my experiences on both sides as an operator and an investor on scaling your business.
Welcome to 2025. And here we are. Everyone puts these podcasts out. Is it a resolution? Are you deciding to do something different? As I look forward to 2025, I think there are lots of interesting things, with the election in our rearview mirror. Hopefully some calm will reemerge in the greater America, if you will. I think there's a few things that are going on that still concern me as I look forward in 25. Inflation isn't under control. I think we are seeing a lot of the optimism from, call it the Trump bump, a kind of a more favorable regulatory regime, if you will. You look at our world, the VC, the venture capital, PE world, folks are projecting, but we have been for the last few years, a more positive deal environment. Now with rates having come down, but now are they slow? Is it really all rates or not? I think the more positive news is, we'll call it just a more favorable outlook, like optimism has taken hold. And they say about a rising tide lifts all boats. I think that's what 2025 is about, being a little bit more positive and optimistic and kind of leaning forward. At the same time, I think I said this on a couple of the podcasts earlier in 24, there remains this 1 foot on the gas and a little bit on the brake, but instead of the full foot on the brake, it's like one on the gas and one near the brake. Think of a student driver. Then the extra brake that sits in the passenger seat, it's almost like that we've got going. And I think our role as Edison or as a board member, as an investor in companies, is to lean into some of the optimism and lean into some of the green shoots or positive that you feel are coming to your business. But don't get caught up in the hype. If things do feel really positive, make sure they are. Because I don't think the fundraising environment is super positive yet. I think this sort of feeling of the stock market rallied, it kind of came off a bit. Things in general feel better, but I don't think we're at a place where there's euphoria. I do think a couple of very specific topics around the industries we invest in at Edison are interesting to observe. So first, FinTech. Financial technology really got beaten down over the last few years, but as everyone saw who's paying attention to kind of financial technology stocks, let's look at some of the big guys like the Squares, the PayPals, but now let's look at some more newer FinTechs like SoFi, a portfolio company of ours, which is called MoneyLion. These companies saw a real bump in their stock price post-election. And I think that had a lot to do with, we'll call it that regulatory outlook. Bitcoin as well, big rally. So the idea that fintechs had been dead, I actually wrote a blog piece on this as well as there's a podcast around fintech. I think you're seeing a resurgence. You're not seeing the euphoria of 2020, 2021 when SPACs and lots of index went out at valuations. It got public valuations that didn't necessarily make sense. You're now seeing the operating performances caught up in a lot of respects to now these stocks that really were beaten up have now come back. And in the private landscape, I think financial technology is going to benefit quite a bit from AI. And if you have a positive regulatory environment plus this AI, what I think is going to be a really interesting AI boom in fintech, that is the makings of a couple of years of being positive again in a sector that had been beaten up pretty good. At the same token, I look at healthcare IT and I've got real caution there. The healthcare space, obviously with that tragic incident in New York where the United Healthcare CEO was executed there in broad daylight or morning daylight. And you look at the reaction from the world on that. I mean, kind of scary how many people thought that was okay, if not celebrated, which is scary. But I think the broader topic of healthcare costs, consumers feeling more of the brunt because high deductible plans have gone up. So we're sort of paying the exposure of what that really sad event in New York that happened has caused a lot more people to look at the healthcare industry. And that also goes to the drug industry. So prescription benefit managers, PBMs have come under scrutiny for cost of drugs. I feel like it won't be 25 in my opinion, but I feel like in 26, late 25, there's going to be some attention turned to the healthcare industry and the insurers themselves as under the microscope. I quite honestly think there's enough on the agenda between immigration, taxes, inflation, and the economy and all the other macro stuff in the world that Trump and the Senate and Congress will have themselves busy before the insurance really becomes, they turn their attention to it. But I have this kind of cautious feeling around the healthcare IT space And this happened back, we call it the Affordable Care Act, but everyone knows it as Obamacare. When there was discussion of Obamacare, the investing industry got really tight really fast because you don't know what the rules are. You don't want to invest in an unknown. So as I think about our audience, if you're a healthcare IT company, just got to keep your eye closer to Washington. And a lot of small companies can't afford lobbyists, but you can get lots of free newsletters and information. So I kind of feel like if you're a healthcare IT company, be wary of what 26 could have in store and any additional if you're in the space, you already know this, but I think as investors, I'm just a little bit of caution, not so much negativity, but just caution. Interestingly enough, as it relates to kind of the enterprise software space, we're recording this on the first Monday of the year, and there's a few new analyst reports around. There's a really interesting article around Rule of 40. A few of the big software companies such as Salesforce and Snowflake have gotten some, new analyst ratings of buy. I do think the enterprise software space, partly because of the need for continued productivity, there's going to be some interesting stuff going on in the enterprise software space here in 25. So all in all, there's like any, kind of investment advice, take it with a grain of salt. I'm not necessarily giving advice. I'm giving kind of guidance, but I think it's more positive than it has been, the outlook. And at the same token, it's not euphoria. Don't let it fool you. If your business is telling you something like there's some weakness, don't think the macro is going to kind of lift you up, is how I think about it because I am on boards. So sitting on several boards, I think you sort of see it. Certain companies have a really bullish outlook. Certain companies have bullish but cautious outlook. And I do think the deal environment, the exit environment in general, is healthier than it's been in a while. So I do expect, and I hate to say this, it feels like the clock's right twice a day kind of comment. For 22, 23, 24, in this exit environment, it's been really sluggish. It's not only rates, it's also, like I said, valuations where companies' performance has actually caught up to valuation expectations. So our industry, the PE industry, had really valued businesses too optimistically at the early days of the pandemic and then that tech euphoria of 2020 and 2021. So I think we were paying too far in advance of operating performance. So why I think the exit environment will get healthier, strategics do need to do some business, some M&A to grow. The financial buyer sees the rates as a more reasonable place to do business in the buyout landscape. But then thirdly, the operating performance of the underlying assets now sort of suggests that valuation expectations might finally be in line with operating performance. And I hate to say finally, because I think there's still good deals that happened over the last few years, but they were less consistent. I was surprised to see literally in today's Wall Street Journal, an article about the Rule of 40. And I'll give one of my venture capital friends a shout out. It was about 2014 or 15, maybe even further back than that. Yeah, it's about a decade or so. A guy named Brad Feld, who's a VC, developed this thesis around the Rule of 40, which means your growth rate plus your profitability should equal 40% or better to be a really healthy business. There was some math behind it. What's interesting is in our world, call it growth equity, where business is more or less focused on growth versus profit. We always use Rule of 40 around revenue growth plus EBITDA. The journal article was talking about, should it be earnings before income taxes, depreciation, amortizations, EBITDA, for those who, again, jargon. But should it be operating profit, which is a proxy for EBITDA? Should it be free cash flow? Should it be net income? What should be the other thing? So if you're company growing 50%, you could be losing 10% on the bottom line and still be a Rule of 40 company. So the point is, if you're going fast enough, you should be trading profitability for growth. And if you start to grow more slowly, you better be more profitable or you don't have a healthy business. It was interesting to see the Rule of 40 article in something as mainstream, if you will, as the Wall Street Journal. And I think it was making the point of, it looks like the Rule of 40 companies that are public are starting to see some reward from being Rule of 40 companies. So I think when it picks up in the mainstream, again, rising tide lifts all boats. Private valuations are tied to public as much as we don't like to think they are. So if the public valuations are going up, the privates will also go up. There's always some imbalance in that. But that's quickly for those who are in the software space and haven't heard that term. Rule of 40 is worth a Google. We're digging in a little more. I would tell you in our world, it's less free cash flow and more operating profit is a better proxy. Because a lot of times, if your cash flow is a lagging indicator and you're investing in cash, that free cash flow will take longer to develop. So revenue growth plus operating profit in the private company landscape is the right proxy to be thinking about if you're trying to be a Rule of 40 business. It's really interesting because having now been in the investing business for over 20 years, and that's only to date myself, it's really to say the pattern that repeats itself almost too predictably is bullish budgets, a first quarter that you make it because you have this up and to the right forecast. All you CEOs out there and entrepreneurs know you have this sort of Q1 builds to a bigger Q2 to a bigger Q3, or as we say, a back half, big growth year. So everyone has this big plans and they steadily guide themselves into the year, almost fooled when Q1 turns out to be strong, because that's because Q1 was budgeted as conservative. And yet the back half was budgeted more aggressively. So it's not so much too late to change your budget because it's only January, right now and when you all are listening to this. But I think as I look at, as a sort of call it a skeptical, I hate to say more seasoned, but someone who's been doing this a long time, the back half loaded, how much is Excel magic and how much is truly grounded in the bookings and the cold hard facts of the business? So I'd say it's inevitable. We look across dozens of portfolio companies. And so I say this not only of 20 years, but even a current view. One thing I've tried to guide is, yes, you want to have your business growing each quarter sequentially, but really examine the bridge quarter to quarter as opposed to the bridge year over year. That year over year bridge may look a little less daunting and you kind of convince yourself you get there, but then you look inside the numbers and sequential Q1 to Q2 to Q3 to Q4. And I hate to admit it, but I don't like how many times I've looked down and gotten to the end of kind of July, August, and folks want to reforecast. That's because the back half isn't quite as strong. Now, there's a couple of things that go on and your business model will dictate some of this advice. Is bookings really a good metric? In the software business, frankly, in all technology companies, we talk about bookings, but you have a really tight handle on your bookings to revenue when bookings actually becomes revenue that you can record in your P&L. And sometimes folks brag about bookings and they get to the back half of the year. Like I said, those customers haven't gone live. The other thing, in businesses that are less true software as a service, and they might be more usage or transaction based, there's another paradigm, which is bookings to live to actually seeing ramp. And again, I hate to speak through more almost like scars on the back than always goodness, but we figured out eventually these companies that have these transaction models where the customers, if you're in a transaction model, like payments businesses, often they'll have customers that pay by the drink. So I mean by transaction was like a toll booth. Customers lie. And I say that, whether the L word sounds like a really kind of tough word, but they have hopes for bigger volume, just like we have hopes for bigger growth if we're an entrepreneur that we might actually be grounded in. So they do it for a couple of reasons. One, to make you, the service provider, the software company, think they're bigger than they are so they get a better deal. They do it to make themselves feel good, and they probably promise the boss. So one bit of tidbit advice I give, and this is very FinTech oriented, but also any kind of transaction model, is really validate when a customer says they're this much volume is coming your way. Do your work. Salespeople by nature have happy years. So they don't want to necessarily ask the hard question of, you're promising me hundreds of thousands of transactions a month. It turns out to be tens of thousands and ramping too. That's the other thing that's the gotcha game in Q1. So, if you really looked at sequential quarter to quarter growth and the underlying bridge there, do you really know if bookings become revenue? Because that has a big back half of the year implication. And then if you really kind of been sober about what your customers are telling you, if your business model's relying on customer information, at the very least, take the 10 or 20 or 30% reduction just to be conservative from what the customer's telling you. Maybe even take it, cut it in half. Because I think the other thing, if I'm an entrepreneur, I'm been backed by an investor like Edison, the good old, it's cliche, but lower expectations and exceed them. Everyone wants to have a big growth plan, and they end up in a place where you're sort of apologizing for those second, third, and fourth quarters. And that's the worst place to be. So managing expectations, beating expectations. I think if you're thinking of fundraising in 25, like I said earlier, it should be a more positive environment. But remember, people in our business tend to fit. They look as long as they can at a business. So if you put out a forecast that's got some big ramp, you better be delivering on it if you're planning to fundraise. So that, again, those sequential quarters become that much more important. But I also think those who say, hey, we're going to grow 30% and you grow 35 or 40, the credibility to an investor goes off the charts. So, promising 50 and delivering 40 and say, but 40 is good, has literally the inverse effect than you think it does. Promising 30 and growing 40, hey, I found a really conservative-minded CEO and management team. This is great. That's kind of what goes on inside businesses like Edison. I think this thread of 25 and what I'll call cautious optimism as opposed to euphoria. In 19, 20, and 21, it was a grow at all cost mentality. And frankly, it took a lot of time for those entrepreneurs to raise money in a more positive time to almost be rewired to realize, lower growth, but profitability. The investors are going to value that more in kind of 22, 3, and 4. And 25, the pendulum is going to swing a bit more to growth, but not irresponsible growth. So I think this sort of tendency to say the market or the investors want to see bigger growth, higher growth. I think what we actually want to see is a profitable growing or a business able to grow profitably as opposed to a business just growing really fast, but doesn't have the unit economics to back up that growth in terms of profit. So don't take that to say you must be profitable today or you're a bad business. That said, I would much rather see a 30 or 40% grower and a profitable business than a 70% grower, 100% grower that I can't really get my handle around the unit economics that's going to show the business to be profitable someday. And I think that's the biggest lesson of the last few years. Venture still has to believe, we're in the growth equity business at Edison, and venture still has to believe in not only the thesis, the people. One VC once said, don't let the numbers get in the way of a good story. So in other words, raise money before the numbers start to expose a weakness in your business model. I think in growth equity, the thing we think more about is sustainable, scalable, profitable growth. And that's why I say, when I invest in a 30%, 5 or 10% EBITDA business, knowing that I could reinvest that EBITDA once I get a handle on all the other levers to pull in the go-to-market, for sure, compared to that really high grower that is just losing loads of money. I think most of the industry, the tech industry, has already learned that lesson the last couple of years. But I would say as optimism returns, the memory of the last couple of years is short and people think it's swung. So don't let if the market keeps rallying, if the optimism continues to grow, don't let that fool you if you're an entrepreneur into thinking grow at all costs is better. It almost never is. There are some exceptions, but they're the rare exceptions. And do you want to be the exception is probably the real question to ask yourself. As we look at 2025 and we look both forward to the full year and a more near in time, I think the optimism that came post-election in the stock market in a more favorable business environment, and that's not to be political, that's just what I think most people would argue happened with the stock market. There's reason for optimism, but 2025 should be taken carefully because there's enough headwinds to not be fooled that it's going to just be a great up and to the right kind of year. And that said, if you're in the fundraising environment this year with a plan to fundraise or you're planning to sell your company or do a transaction, I do think this is a year that you're going to find to be a favorable one in general. Of course, these predictions always tend to be more wrong than right, so it's always risky. But I think as I synthesize the whole outlook of 2025, it comes simply down to as optimistic as I've been in a few years, but with enough to worry about to not declare that this is going to be a great year for deal making. So that's my simple kind of synthesis of 2025. Lots of people do resolutions. And as I think about resolving at a personal level, what am I going to do in 2025? I think what I've resolved to do, and we'll see how well this plays out in just weeks, let alone months. One of my CEOs I backed once said this, it was like their values on the wall. You have 2 ears and one mouth, use them in proportion. So to try and listen more effectively and make sure I'm really hearing what the other side is saying, whether that's a CEO, another board member, my wife, my kids, my coworkers, I think trying to talk less and listen more is a personal resolution for 2025. And I'm not sure how I measure that. We'll see. I'm sure plenty of colleagues will tell me if I'm actually doing it in a couple of weeks, but that on a personal level, folks always ask. Interesting to think about, how does 2025 look compared to the last 20 or 30 years of my career, both as an operator, as an investor? Where do I put it? We can all look back to the internet bubble and crash and kind of look at what happened, when the pandemic hit so hard. We can kind of recognize like 2000, 2001 to be like those early pandemic months, if not year, before things really bounced back. I think as I look back in 25 and look way back, it's a really interesting time to say, what does it look most like? I'm not old enough, for better or worse, to really know what America felt like in 1980, but I was only 10 years old in 1980. I think that positivity, and let's focus less on what can go wrong versus what can go right at both a personal and business and political level. We're not all done screaming at each other on social media, but I think people are beginning to have had enough of it. So I think there's that issue. And, there are plenty of people who go to their corners in the political landscape and will argue that it's going to be better with, they either hate the orange haired guy or they love him, it seems. But the bottom line is there is a positive energy that seems to have taken hold the last, 60, 90 days of the year and headed into 25. And I can't remember a time in my lifetime since then that it really felt that same way. But I think relative to maybe the first Obama election, people got really excited, but that was sort of the change of an African-American becoming elected president. I think that was that kind of euphoria. That's different. This is both the economic, because you got a deal-making president and you have an environment that was so bumpy. So we'll see if folks, want to chime in with comments or questions or their own thoughts of what does 25 most look like. But I think this sort of positive mojo, and frankly, America needs it. We've been too down on ourselves. It's a great country. We're so lucky. And I hope that's kind of what happens in 2025. We regain a little bit of our own optimism and belief in ourselves. in a nutshell, how to encourage or give the confidence in the CEO. My grandfather, who said, it's cliche, it was his cliche, plan your work and then work your plan, the focus on execution. It's great to be a strategist and to be a visionary, but the hard work of every day is really what matters. And I actually say this to my team, so maybe I've turned into my own, but try and figure out how to stop measuring effort and measure results. And I think, it's really interesting because I think we all went through this like remote, in office, hybrid, let's get back, where we're measuring effort and activity, we're measuring results and all that conversation. I think people convince themselves they're measuring results. But I think at the end of the day, both you as CEO, you as senior leadership team member, you as startup entrepreneur, measure weekly. Daily's hard, right? But what did I get done this week? Some folks would say every day you should measure it, but I am a big believer in journaling. And, sort of what I tried to do for a couple of years was journal every day more generally. I think what I actually think about now is, the to-do list more in a, what do I want to get done list this week? Because to-do list can feel a little bit tactical, where if you kind of look at what I've accomplished this week. So let's stop measuring effort and start measuring results. And let's think about, what did I accomplish list, what I want to accomplish this week, and what did I accomplish supposed to to-do list? Because paying the bills and dating my LinkedIn profile is interesting, but it probably isn't all that effective in the results category. Food for thought. I'll give a little plug, and I hope I can deliver it regularly. We're going to publish an old school newsletter, kind of a view from where I sit. So I'll be on the lookout in the next week or so with a kickoff to the year. And I'm going to try and combine what we're calling kind of 5 things. And 4 will be kind of micro and 1 macro. Every kind of 6 to 8 weeks, come out with a new sort of these 5 things. So hopefully, let's put myself out there, but back to the resolution, not just listening better, but actually kind of going some old school newsletter too.
Thank you for joining this episode of Electrifying Growth. A special thanks to this week's guest for sharing their time and insight. For more resources, inspiration, and a look inside the Edison Partners network, sign up for our newsletter at www.edisonpartners.com. Click on the Stay in the Know button in the top right corner of our webpage. Thank you again.